Stick with me for the next 10 minutes and I'll show you exactly how money market funds work, why they're crushing traditional savings accounts in 2026, what the real risks are that nobody talks about, how to actually open one today, and whether they make sense for your specific situation. No fluff, no sponsored garbage, just the honest breakdown. Let me kill the confusion right now. A money market fund is not a savings account. It is not a checking account. It is an investment fund, but a very boring, very conservative one, which is exactly why millions of people are pouring money into them right now. Here's what happens behind the scenes. You put money into the fund. That fund pools your money with thousands of other investors. Then, professional fund managers take that giant pile of cash and lend it out in extremely short-term loans. We are talking days to weeks, to governments, large banks, and corporations with strong credit ratings. In return, those borrowers pay interest. That interest flows back to you as yield. Think of it like this. Imagine your neighborhood organized a lending club. Instead of one person lending money to one borrower, hundreds of neighbors pool together and lend to only the most reliable borrowers in town. The risk stays low because the loans are short, the borrowers are trustworthy, and the money is always moving. That is essentially what a money market fund does, just at a trillion-dollar scale. The reason this matters right now is timing. The interest rate environment in 2026 has kept yields elevated compared to what we saw in the low-rate era of the early 2020s. And your bank? They just never passed those higher rates on to you. But the money market fund did. Which raises a question worth sitting with. Why would your bank keep paying you almost nothing when better options exist? Let's talk numbers without getting too deep into the weeds. The average traditional savings account at a large bank is currently offering somewhere between 0.4 and 0.6% annually. That is not a typo. Meanwhile, many money market funds are sitting at yields between 4.5 and 5.2%, depending on the fund and the current rate environment. On a $10,000 balance, that difference is roughly $400 per year. On $50,000, you are looking at nearly $2,000 you are leaving on the table every single year, just by keeping money in the wrong place. Why are banks still paying so little? Because they can. Most people never move their money. Banks know this. They count on your inertia. The branch on the corner, the familiar app, the debit card you have had for 12 years. That comfort costs you real money. Money market funds do not have that same inertia advantage. They have to earn your business by offering competitive rates. And right now, with the Federal Reserve having kept rates higher for longer than many predicted, these funds are genuinely benefiting. The short-term loans they make are repriced constantly, meaning when rates stay high, yields stay high. Your savings account rate, on the other hand, barely budged when rates went up but somehow always finds a way to stay sticky at the bottom. But before you sprint to move every dollar you own, there is one thing about risk that almost every YouTube video conveniently skips. And it is more nuanced than you probably expect. Let's be completely honest here, because this matters. Money market funds are considered very low risk, but they are not zero risk. There is a difference, and you deserve to know it. First, they are not FDIC insured. Your bank savings account is insured up to $250,000 by the federal government. If your bank collapses, you get your money back. Money market funds do not carry that same government backstop. They are regulated by the SEC and considered extremely safe, but the protection works differently. Second, there's something called breaking the buck. This is rare, but it has happened. Breaking the buck means the fund's share price drops below $1, which is the stable value it is supposed to hold. It happened in 2008 during the financial crisis, when one large fund had too much exposure to Lehman Brothers debt. Investors panicked, withdrew money rapidly, and the fund could not maintain that $1 value. The government stepped in and backstopped the industry, but the event rattled confidence. Third, these are not designed for long-term wealth building. The yields are attractive right now because of current rate conditions. If the Fed cuts rates significantly, those yields will drop. You are not locking in today's rate forever. So the smart way to think about this is, money market funds are excellent for cash. You need to keep liquid, accessible, and earning something meaningful, like your emergency fund, money you are saving for a home purchase, or excess cash sitting idle. They are not a replacement for investing in stocks, bonds, or retirement accounts for long-term goals. The next question most people have after hearing all this is completely reasonable. How complicated is it to actually open one? The process is genuinely simple. You do not need a financial advisor. You do not need to be wealthy. You can open a money market fund in about 15 minutes with most major brokerages. The biggest names in this space are Fidelity, Vanguard, and Schwab, all of which offer their own money market funds with competitive yields and extremely low fees. You can also access them through platforms like Robinhood and Webull if you already have accounts there. Here is the basic process. Open a brokerage account if you do not already have one. This is free. Fund it by linking your bank account and transferring money over. Typically takes 1 to 3 business days. Search for a money market fund. Common ones to look at include SPAXX at Fidelity, VMFXX at Vanguard, or SWVXX at Schwab. Review the current yield and the expense ratio. Lower expense ratios mean more of that yield actually reaches you. Then buy the fund, just like you would buy any investment. One thing to watch. Some funds have minimum investment requirements, though many have dropped minimums significantly. Also check whether the fund invests in government securities only or includes some corporate debt. Government-only funds tend to have slightly lower yields, but are considered the most conservative option. The part that surprises most people is how fast you can withdraw. Most money market funds settle within 1 business day, making them nearly as accessible as a savings account for practical purposes. Now that you know how it works and how to open one, the real question is whether you actually should, and the answer is not the same for everyone. Here is the honest filter. Ask yourself 3 questions. Do you have cash sitting in a bank account earning under 1% that you will not need for at least a few weeks? If yes, a money market fund is almost certainly worth considering for that portion of your money. Is this money part of your emergency fund or short-term savings goal? Perfect use case. Keep it accessible, keep it earning. Are you trying to grow wealth over 10, 20, 30 years? Then a money market fund should be a small piece of your picture, not the whole thing. Long-term investing requires assets that grow with the economy, not just float above inflation. The bottom line is this: money market funds are not a secret. They are not complicated. They are just underused because banks have done a masterful job keeping you comfortable right where you are. In 2026, with yields where they are, choosing to leave cash in a low-yield savings account is a decision that costs you real money every single month. You now know how these funds work, why yields are strong right now, what the risks actually look like, and how to get started today. If this video helped you understand something that your bank definitely does not want you to know about, drop a comment below telling me where you currently keep your emergency fund. I read every single one. Hit the like button if you want the YouTube algorithm to show this to someone else who needs to hear it. And subscribe if you want honest money content every single week with zero fluff and zero sponsored bias. I will see you in the next one.